All right, welcome to this live of this evening. So I'm going to wait a little bit so that people join, and I'll be opening my slides. So today we'll be discussing about business finance, being fluent in the language of money, because I think that if you are going to speak the language, you need to speak the language of the land to properly, attract partners, be able to add value, but also most importantly, be able to be conversant and know where things are going from, or what is the overall structure of the landscape in which you're operating in. So in this video, I'm going to promise you a few things. You're going to wrap up this video with a knowledge of business terminology, of finance and business terminology, that is going to equip you to be able to have a conversation with your accountant, with investors, and other stakeholders in the finance aspect of your business. And please, if you haven't yet subscribed, please make sure that you subscribe. That's the best way to show me support. And also, please, if you find value in this video, press like, and also share this video with your friend who are in business, because I believe that the knowledge that we're about to share today is going to be paramount. You can't have these conversations with investors if you can't even speak the language of finance. And I think I was speaking to someone today, and we were talking about how they were telling me how financial literacy is actually one of the biggest bottlenecks that causes founders to not run their businesses properly. So we are going to cover those terminologies in this video, and stick around so that we go together. So finance is quite easy to understand if you focus on what's important. So what is finance? Finance is the art and science of watching the money flowing into and out of the business, then decide whether or not it's enough to keep going. So that's what finance is really tracking. So the money or sales, or the liquidity you have in your business, is the blood of the business. If you have a body, all organs are functional, but there's no blood in the system, then your body is going to collapse. The whole hardware is going to collapse. So that's what finance is. So finance is the blood of the business. All right. So what's accounting? Accounting is the process of ensuring that the data you use to make financial decision is as complete and accurate as possible. So accounting has a lot to do with making sure that, okay, quantifying the numbers that you're tracking. Okay. Next, so finance concept every business owner must know. So we are going to do a deep dive into these concepts, so that when someone, tell you a term or mentions a term, you're not going to be lost. Okay. The first one is profit. I think this one probably, if you're watching this video, you might be already familiar with this one. So what is profit? Profit means bringing in more money than you spent. So you've spent more than if you're spending more than you're making. If you're spending less than you're making, then you're making a profit. So it's the difference between what you earn and what you spend. Okay. And so there's profit margin. So profit margin is often abbreviated to margin and measured in percentage. Is a measure of how much you keep on the revenue you collect from a sale. So the profit margin is measured in percentages. Okay, so if you're making $100 and you're spending $50, then your profit margin is 50%, because you've spent half of what you've earned, and you've kept half of what you've earned. So the margin is 50%. And you can do the math. So margin is always in percentage. So when someone says, okay, what is the profit margin that you're making on this one? So you take what you've earned minus what you've spent, or the cost of the services in general, and then you do a percentage, and then it shows you how much you've earned. If you made $100, you spent $30, it means 30% is no 70% is the profit, and 70% is the profit margin. So that's what a profit margin is. Okay. Now there's what we call value capture. So what is value capture? So value capture means keeping a portion of the value created every time someone buys or uses a product or service. So if you take too much, people might find your offer less appealing. So value capture is more also similar to, it's almost similar to profit margin, but they call it value capture because it's the profit that you're earning from the money that you're making. So it means if you're making, let's say, you have a product that you sell at, I keep saying $100, okay, but you're selling it at $100, but it probably cost you $20 to make. So you're capturing $80. So that's the value that you're capturing out of the $100 in which you sell. So sometimes it's always advisable that instead of capturing $80, you can actually capture $50 and you'll be fine. So which means if the cost of making the product is $20 and your value capture is $50, you could sell the product at $70, and that would be the best way to that's the best value to capture, instead of capturing a lot and risk to actually lose clients. So there are two main ways to do this. So maximization is keeping as much value as you can. Minimization is keeping only as much value as you need to stay sustainable, so your offer stays as attractive as possible. So it's always advisable that you don't want to have like 200x profit. It's not necessary, because you're putting a burden to the buyers, to your clients. So instead, you could capture a smaller value. You can minimize the value capture and have a more sales, increase the volume of sales that you're doing, instead of capturing a lot of value, and it puts burden to the client and actually prevents potential clients to actually step in the door and buy from you. So make sure that the value that you capture, the profit that you make, is not as humongous that it becomes a burden to your customers or potential clients. So value capture is a balancing act. You need to earn enough value to make your time and effort worthwhile, but not so much that customers no longer see a good reason to choose you. So this happens all the time in business. Good businesses, this is what happens actually. This is why I believe Chinese are very successful in business. When you go to buy something in this Chinese shop, especially when you go to China, you'll find that things are very affordable. Okay, it does not mean that it's not as expensive as we might think to make those products. Sometimes it's that the mindset of Chinese is that, I'm going to make this product and make it as affordable as I can, and sell as many items as I can, as many units as I can, instead of being greedy and say, you know what, I'm going to price it as high as I can, so that if one person can buy it, then it's not always a good strategy. It's not advisable to do so. And learning from Chinese, we very well see how when you lower the price and you capture enough value to stay in business, it's actually very easy. But this does not mean that you have to lower the quality. No, the quality has to stay where it has to stay, because there has to be always a threshold. You need the threshold to not go below the acceptable quality. But again, make sure that whatever you do, you don't go below at the threshold of quality. But again, don't go way above what people can afford comfortably. So keep that in mind. The other term is 5 is sufficiency. Okay, so financial sufficiency is when a business earns enough profit to make it worth continuing in the long run. Once you reach this point, you're successful, no matter how much money you actually make. So financial sufficiency is when you pay the employees. Okay, you've maybe paid rent, you've paid everything, you've paid yourself, and there is actually money remaining in the bank account. Okay, so because when you reach that point where you can spend everything, spend money on employees, on yourself, cover all the expenses, and remain with some money in the bank account, it shows that you have become financially sufficient and you have become officially a successful business owner. And this is because officially this is what we call to cross the break even point. Okay, the reason why most businesses fail, it's not because founders give up. Businesses don't fail because founders give up. Businesses fail because very few of them actually reach financial sufficiency. Okay, we've seen how most of the time in the startup sector, we always see how these, of course, that there's a number of reasons that cause these startups to fail, but we've seen how most startups fail because they're not bringing in money. No one is buying whatever they're selling. If it's a subscription, if it's a service, no one is actually partaking in the services, and it causes people to actually churn. So the churn rate is crazy, plus the burn rate, then the business is run to the ground. So make sure that you aim for financial sufficiency. And this is something that probably, when you're starting in business, it's very hard to understand. But really what you want is to stay afloat. That's what I actually tell all businesses that I consult with. I tell them, look, your purpose in this business is to not sink. And how do you prevent sinking? By making enough sale so that you can keep going. You can keep paying bills. You're paying bills. You're honoring your social obligations. You're covering your expenses, and you're a responsible member of society. If you can do that while doing that business, you've actually succeeded. Then you can start thinking about how either to increase the productivity in your business, to increase the earnings and the gains in your business. But without financial sufficiency at first, you risk to not be able to advance in your business and actually sustain it. All right. Number 6 is valuation. I think we've heard this being thrown around for quite a number of time. If you've been in the startup ecosystem, or you've done a business at some point. But valuation is an informed estimate of company's total worth. So a company valuation goes up when it earns more revenue, has strong profit margins, keeps a healthy bank balance, and looks promising for the future. So the higher its valuation, the easier it is to borrow money. The higher its share price, okay, if it's a listed company, or if it's on the stock market, or has shareholders, the more it could sell for if acquired. Valuation is also crucial when bringing in investors. The higher the valuation, the more money you can raise for each share that you sell. So the company valuation is, all of these things are considered. Okay, there is revenue, there is profit margin, there's the bank balance, there are assets that you have. There is also the volume of your customer base, attraction in general, the size of the size of the staff that you have. All of that plays in the game, or the collection, the collective of what is considered when people are thinking of valuation. That's why when you're about to invest, they ask you, okay, you're raising, let's say, $500,000. At what is the current valuation of your business, pre-money valuation? You could say, I'm raising $500,000 at $2 million valuation. So it means you're probably that $500,000 is going to be 25% equity in the business. Okay, because it's it's 4 times $500,000. 4 times it's $200,000. So that's the valuation of the company, and they're going to ask you, how did you reach that valuation? And you should be able to defend the valuation that you have, because again, you can't say this is my valuation, and when they ask you how did you reach this valuation, you can't actually explain it. So you have to explain using these things, using the revenue, the profit margin, the customer base, the size of the staff, the asset of the business, and then you can justify the $2 million. Okay, now cash flow statement. So what is a cash flow statement? So a cash flow statement, it's an examination of a company's bank account over a certain period of time. Think of it like a checking account ledger. So deposit of cash flow in and withdrawal of cash out. Ideally, more money flows in than flows out, and the total never goes below zero, because you don't want to go below zero. But this is what a cash flow statement, it shows how the money flowed in the business and flowed out of the business. So it's that's all it is. So when they say, okay, show me the cash flow statement, they're asking you, okay, show me how money went in the business and out of the business in a specific period of time. Then you can present your cash flow. Number 8, income statement. So an income statement is a financial report that shows whether a business is making profit, If a business carries inventory or offers credit to customers, looking at cash flow alone can give a misleading picture. Okay, because you need to be very, very careful. Sometimes, so to truly know if your sales are profitable, you need to connect each sale to the expenses that went into making that sale. By matching revenue with the related cost, you can see whether you are actually earning a profit. So an income statement shows whether there is profit actually, because if we don't match the what has gone in and what has come out, then you're going to confuse the fact that you're either making money. You're not going to be able to determine specifically if you're making money or not, because the income statement is going to show you exactly, okay, this is the money you've made and this is actually what it has cost you to make that kind of money. So let's say you've done a sale of, let's say, $5,000 or $2,000, but how much did it cost you to make that sale? Okay, maybe you've spent $1,000 or $1,500. That means that the actual profit that you've made is $500. So that's easy to understand. It's similar to the profit that we're talking about now, though. So a balance sheet shows you what a business owns and what it owes at a specific point of time. So balance sheets are useful because they reveal key details about a company's financial health. So by looking at a balance sheet, you can tell if the business is solvent, whether it's struggling to pay its bills, and how its overall value is changing over time. So in the balance sheet, you want to see those assets and liabilities plus owner's equity. Okay, so and those things has to always balance. And if it's not balancing, then there is a problem. I think I did not add the photos to show how this is done, because I would be going into, like, teaching finance and everything. But I want you to capture this and know exactly, when you see a balance sheet, you know that, okay, this is a tool, a document that shows me, okay, how much do I owe, how much am I owed. So with that in mind, then you can have like and you can also go ahead and do your own research and type examples of a balance sheet. But that's how you want to understand it. So there's assets and then liabilities and owner's equity that shows, okay, this is the money that I have in the bank account, these are the assets I have, these are the liabilities, debts that I have, and these are owner's equity that I have in the business. Okay. So there are things called financial ratios. So the financial ratios, I did not want to go into it, but they are beneficial because they allow you to make comparison very quickly. So they are useful for sanity checking profit, debt, cash, and efficiency without spending too much time. So every business has a small number of important ratios to consider. So it's worthwhile to do a bit of research to see what they are for your industry. So financial ratios differs all the time, and a ratio is comparing a number to another. Okay, so it could be a ratio. Let's say you could say, if we have a let's say we have, if you say in a class there is 5 students, let's say you have a school where most of the classes you have 5 students and 3 desks. So you're going to see the ratio of the number of students to the number of desks. So then you take 5 out of the number of desks, and then you could see that it's probably one desk per, for 2 students. Then it can show you the ratio that you're actually looking for. But a ratio is specific for each industry. If you work in media and construction or other industries, the ratios are going to differ. So my advice is, go do research and analyze. Okay, if I work in mining, I work in infrastructure, construction, project management, construction, real estate, entertainment, music, art. Go and see, okay, what are the ratios on Google, like what are the financial ratios that are used in accounting for this specific industry, so that you know. Now, cost benefit analysis. Now, these terms you're going to, the reason why you need to know these terms and at least know what they mean is because when you're having a conversation with business partners, potential investors, stakeholders, they are going to throw around these terms. And as an entrepreneur, you want to be able to catch those terms and know what they mean and jump into the conversation. Because I always say that it's impossible to have money if you can't speak the language of money. You need to speak the language of money. And speaking the language of money is knowing this terminology. It's very funny how, money should be something that is very easy to understand. It should not be as complex as it is. But I think finance is just the linguistic of money. It's technically like when you start studying finance, you start seeing how money is really an idea that is expressed in different way. Just because you move money from here to here, it's called an investment. You move money from your business to a bank account of Rwanda Revenue Authority or your revenue authority in your country, it's called taxation. You move money from your bank account to paying a parking company, it's called parking fees. You move money from, it's called school fees. You move money here and there, it's called profit. But when it's in my account, it's called revenue. That's what finance is. So you can literally take, $100 bill and say, look, this is my, so if I spend this money, it becomes my expense. But when you get it, it becomes profit. And you're like, wait, it's $100. It's the same dollar bill that we have. But why does it have different names? Well, that's finance. So finance tracks that. And it's very paramount as an entrepreneur to know exactly these types of terminologies. So if they ask you, so what is the cost benefit analysis? What do they mean? So it's an analysis, the process of looking at a potential business change to see if the benefits outweighs the cost. So basically, they're asking you, is this something, did you measure? Is the risk worth it? So what is the cost benefit analysis? The analysis between the cost that this thing is actually going to cost us to the benefits of it. And when they tell you, okay, what was it? What is it? They could call it like cost benefit analysis. They could call it risk analysis. Did you analyze the risk? What are the risk mitigation strategies that you're going to use in this case? So you have to be fluent in this language, because I always say that the level of your financial literacy is going to determine or limit the amount of money you make. People who know a lot about money tend to make a lot of money. Okay. If you know a lot about money, you're going to make a lot of money. If you know less about money, you will make less of it. Okay. And this applies to one, the mindset that it gives you. When you start thinking about money from the finance perspective, you're going to understand, tax deduction. You're going to understand tax exemption. You're going to understand the fundamentals of accounting. You're going to understand LLCs and corporation and trust and insurance. You're going to understand that the world of money is an idea that you need to understand. It's a lens that you need. It's like entering a new country, and you need to know whose office you need to knock on to get whatever you want, what buttons to press so that you get what you want. But the lesser you know, and I think this is could be a huge disadvantage as an entrepreneur, because the game of business is tilted towards those who know a lot about money. It's not built, the world of finance, the world of money is not built. The people who built the world of finance, and the people who manages these huge chunks of cash, they are not doing that expecting that the regular guy who knows nothing about money is actually going to benefit from this. No. That's why it's very important to be educated financially. That's why every rich person that you know in your neighborhood, or whether you know them or not, or whether you know it or not, they have financial advisors. They have personal accountants, because they want to make sure that every loophole that is in the system to help investors or to help business owners is actually going to benefit them. Okay. And it's your sole benefit. It's actually your biggest advantage to know these terminologies, to be aware of these terminologies, so that you can take advantage of it. Right. So there are 4 methods to increase revenue. You can increase the number of customers. You can increase the average transaction size. You can increase the frequency of transaction per customer, or you can raise prices. Now, this is very interesting because most of the time when you ask a business owner, okay, how are you going to increase revenue in your business? The first thing people think about is, oh, I'm going to raise my price. But hello, that's one way to increase revenue in your business. How about doubling the number of customers, improving customer care or customer experience so that you have more word of mouth and you attract more customers? We talked about value capture early. Now it has started to become a full circle moment for us in this session. Okay, so increase the average transaction size. How about causing that one customer to actually buy more? Not only buying more, but actually buying more often. You're still talking about one customer. So you can cause that, so you can increase one revenue. You can increase your company revenue without even increasing the number of customers by just increasing the average transaction size, frequency of transaction, and slightly raising prices. Or you can increase the revenue in your business without touching prices by just increasing the number of customers, transaction size, and frequency of transaction per customer. Now, that's what I call Business 101 mastery. This is mastery because amateurs don't know this. And if you're watching this video, whether live or not, I'll say if you've reached this point, give me a like if you agree with that, or if you like, what you're hearing. But man, this is really good because I see so many business owners struggling. They'll be like, "How am I going to increase? I want to increase revenue in my business," and they're like, "But if I increase prices, then there's a problem. Okay, I'm stuck." There are three more other ways you could use. Like I said, financial literacy. There's something I've read, that there's a verse in the Bible says, um, "My people are destroyed by a lack of knowledge." Knowledge literally leads to destruction. And it is always the guy who knows less who is always at a disadvantage. The less you know, the less advantaged you are going to be. And I think in this era that we are living in, we cannot afford to know less. Okay, you have to know more because the leverage today is who knows more. Just imagine, you wake up in the morning, you're sweating, you're panicking because your business is not making enough money. You're not sufficient, as we were discussing. You've tried with value capture, but things are not working. And you're like, how in the world can I increase? And the guy who have seen this video or read these things where I've read them is going to be like, oh, have you thought about increasing the average transaction size? Well, what does that mean? Oh, not only that, you can actually increase the frequency of transaction per customers. Oh, how do I do that? Okay, maybe you need to incentivize them to buy more. Maybe you need to incentivize them to recommend your services. And that's where the advantage is. Because most of the time people are going to say, "Oh, I'm just going to give up." So don't do it. Okay? There are so many ways to do things. But like I said, this is a financial literacy type of course. And, it's always the people who speak the language of money who makes more because they can have that conversation with money and actually know what to do. So pricing power. Pricing power is your ability to raise your prices over time. Okay. The less value you capture, the greater your pricing power. It's related to the economic concept of price elasticity. How sensitive are your customers to price variations? The higher the prices you can command, the more reliably you will be able to collect sufficient profits to remain in operation. Now, I love the fact that they have tied pricing power all the way to, less value capture. When you build a business where, the prices are, they were affordable at the beginning, in the first, 12 months, 18 months of the business, you provide the best services. People are going to be drawn into the business. They will love the business. And when you bump the price, people are going to be there. They will stay because you've serviced them to the best of your ability. And that is what we call pricing power. You have the power to raise prices and people can still buy from you. They're not going to churn, they're not going to go away, they will stay and stick with you. So, a business that has no pricing power, what it tells me that even in the beginning, the value capture has had a problem. You're either selling something that they don't need, there's a problem there. And this happened to me in different settings. For instance, the barber place I used to go, the barber shop where I used to go, when I started going there, the price and that price comparing to now, it has been bumped. It has been bumped, I believe, for like between 15 to 20%. Okay, and I'm still going there because before the value capture was fine. I was okay. I was like, okay, this is a nicer place and so forth. Okay, it can be justifiable. When they bumped it, I was like, anyways, they have been servicing me really well, so I'm going to stay. And on top of that, you actually tip the barbers. So that's pricing power. That's the pricing power that you have over your client when you service them properly. Okay. So lifetime value. So lifetime value is the total amount a customer is worth to your business over the entire time they buy from you. So the more often they purchase and the longer they stay, the greater their value. The higher the lifetime value, the more you can justify spending to attract new customers and keep them satisfied. Like I said, barbershops. Okay. When I started, the kind of how do you call it, like trimmers they were using before are different from the trimmers they're using today. They have bought better new models of type of trimmers. The setting has changed. They have bought new chairs over the years I've been with them, because my lifetime value of as a customer of that barbershop has actually shown them that the more they invest in pleasing me and pleasing customers like me, they are actually going to keep me even longer. So so you want to do a business where people keep coming and make sure that they are pleased. How do you make sure that they're pleased? You serve them to the best of their ability. You capture a modest value capture. You capture modest value, and then when you bump the price, it will be fine. But also, you're going to increase the lifetime value of them with your business by providing even better services through spending even a little bit more. So that's how you do it. And lifetime, but I always say that, and this is a principle that is known in the business world. It's very easy to keep a customer that you already have. It's easier, it's commendable than actually look for a new customer, because you break the lifetime value and then it becomes challenging. So why don't you keep the customer that you actually have by servicing them well, by pleasing them, and make sure that they're not going anywhere. And once that's on unlock, then you can say, okay, now I'm ready to bump the price. Now I'm ready to increase the prices. Now I'm ready to capture more value. But make sure that in your mind, you're like, okay, this customer, we are going to be together in this form of like arrangement, trade, exchange for the next 5 to 10 years. Especially if you sell commodities, services, and so forth. Those schools where it's where your dad went, that's where your mom met your dad, and that's where your elder siblings went, the cousins went, the friends of the family went, so everyone is there. So it's a lifetime value that is very, very long, that the school have enjoyed Why? Because they have taken care of them. They'll be like, yeah, we went to that school, no need to change, that's where I went to school, go there as well. Okay, because even when I have new friends, like friends in town who are new in town, I'm not going to take them to a different barber. I'm going to bring them to my barber because he has done a good job. So lifetime value wise, I'm locked in. And to the extent where when you go to when I go to a different barber, I actually feel bad. I feel like I've betrayed or cheated to this guy. That's how customer loyalty is built. And when you understand that, you actually build loyalty, because there's nothing like a loyal customer. When someone is already convinced that you're the best person for whatever you do in the business, that's the best thing. Because if you keep them pleased, they're going to bring them. They will go and call their friends. Okay, nice. So 14, allowable acquisition cost. Okay, so this is cost of customer acquisition is the marketing component of lifetime value. So the higher the lifetime value of your customers, the more you can spend to attract new customers. The higher the lifetime value, the higher the AAC, the more each new customer is worth, the more you can spend to attract them and keep them. So in terms of the acquisition cost, the customer acquisition cost, so long as you have now mastered pleasing customers, then you can go ahead and spend more to get more customers, so that in the end, you can actually have even more customers. Because now that investment, the cost of acquiring the customer or the cost of bringing in a new customer in the door is actually justified. So, and this can be done by running ads, could be done by running like open houses, could be run by running social media accounts, content creation, and so forth. So this is very important. So make sure that also on the side of acquiring customers, so long as you've mastered how to extend the lifetime value of your customers, you can spend more to acquire more customers. So it's acceptable. Okay, so I'm explaining the terms, but also bringing them in the context so that you understand. Okay, what does that term mean in my everyday life of running a business? All right. Next is overhead. So these are the basic operation costs. Could be rent, could be staff, could be raw materials, could be transportation. Anything you need on a consistently on a consistent basis to run your business is an overhead cost. That's it. So overhead is just overhead. They go over the head all the time. That's how I usually explain it. So these are the costs that you need to run the business, to keep the business going. If the raw materials, the staff, the ingredients, everything that you need to run properly the business. And with lower overhead, you also gain more flexibility depending on the business you're running. So there are two types of costs. There are fixed costs most of the time, the overheads we're talking about, and also variable costs. So let's say you have, a content creator that you've brought in to come and produce content and post them on their social media so that you attract more clients in a different niche. That's not something you do regularly, but it's a cost that is going to vary. Today, you're going to use someone who has 10,000 followers. Tomorrow, you use someone who has 5,000, 10,000, 20, 25, depending on the way your business is growing and the kind of target market you are targeting currently for that, specifically for the business that you will be running in that very moment. So the cost can vary or be fixed depending on that. Then there's something called incremental degradation. So this is the process of making a business offer worse and worse by trying to cut costs. Saving money doesn't help if you need to lower the quality of your offering to do it. And so this keeps happening. It's a negative spiral effect that happens in most businesses, where they're like, okay, we are not getting more, like, this is more about increasing prices and increasing revenue in the business. Sometimes you might think that the reason why they're not coming is because the prices are very high. Okay, and you start lowering the price. And because you've lowered the price, you lower the overhead, you lower the quality of ingredients, you lower the quality of the stuff, and then consequently, you have lowered the quality of the product. So lower prices, lower quality products, and then it starts, degrading incrementally. And you don't want to go there as a business. So what I advise is, if you're not getting clients in the business, the first thing you should think about is not prices. The first thing you should think about is the price, is the product that you're serving these people. Are they actually being served what they want? The first thing you have to think about is talk with the customers that used to come at your shop to buy from you. Talk to your former customers. Ask them, okay, you've not been here for a while, and I'm not calling you to come and buy from me, but what actually happened? They're going to tell you everything. Instead of spiraling, ask them, okay, what happened actually? They will tell you, that guy that you used to work with was not actually a good guy. That's why we left. Or they'll be like, one day I ate your samosa, and the meat inside were really off. I felt sick. Or they're going to tell you, oh yeah, I came there, man. I came with guests for the first time. They were just exploring the restaurant, but when they reached there, it was really bad, and we just decided to, not take a chance again. So you start seeing patterns because you write down that feedback. And I'm not saying that actually this should not be done by employees, it should be done by the business owner. When the clients are dropping, when the revenues are dropping, the first thing you should do is not to lower prices. The first thing you should do is to talk to customers. What's happening? What is going on? Is it the season? Is it the product? Is it? Because even if the customers that you used to sell to no longer buy from you, because maybe they could have moved, or because maybe you're selling something of a high end, they only buy it as a treat, they could actually recommend you to others. It's not going to kill your business. Okay? So make sure that instead of starting to lower and degrade and lower the prices automatically, speak to the customers, ask them what happened. And then from there, you can say, oh, you know what? Actually, this is what I'm going to fix. This is what I'm going to work on. But don't assume. Don't assume that just because you're not making sales is because maybe there's something wrong with the product, there's something wrong with the price. No, speak to the customers, because sometimes the product is fine, the price is fine, but it's how people are being served. Okay, maybe everything is fine, but the way the orders are delayed. Maybe everything is fine, but there is the road that used to be in front of your store and the parking lot. By the way, did you believe that recently I went to a supermarket here in Rwanda, and they charged me for parking? Okay, I'm like, dude, this is not like, you have this. I've always parked here for free. Why are you charging me parking? And that has been a turn off that I don't remember the last time I was there, because I was like, wait, this I could understand if this was a paid parking, even since the beginning. But this is the first time that you're introducing this after years you've been operating in this neighborhood. So why are you charging me for parking? And mind you, the parking fee is not a lot. It's like 100 Rwandan francs. It's literally a coin, or 200. But that inconvenience, it causes something in the brain that tells me, I'm not going to go there. So if the owner of the supermarket could call me and say, "Hi, Willie, you used to come here to buy donuts. What happened, man?" I'll be like, "Man, like, look, I came here, I came there, and they charged me parking." I was like, it's not worth it. And they'll be like, "It's only 200." Yeah, I know, but it's inconvenient anyway. The psychology of the customers. So, but the supermarket owner probably is going to say, yeah, we're not getting clients. Is it because maybe we are no longer positioned well? Something did that, someone happened. And then they're just going to be in a linger and a spiral that is going down in assumptions, which is exactly what they are, assumptions, but it's not the truth. They're not facts, they're not data. So I always recommend that you talk to the customers. If someone used to buy from you and they're no longer coming, and probably you're 100% sure that it's not because they moved. You call them, ask them what is happening instead of just assuming. Break even, I think we talked about this, is the point where your business total revenue exceeds total expenses. So this is why they call it a break even. That's where you break the curse of being all under the revenue curve, and then you break into making the revenue and making and joining the stage of being sufficient as a business. Okay. Number 18, amortization. So amortization is the process of spreading cost of a resource or investment over its estimated useful life. Okay. Let's say you're saying, okay, I'm going to buy a car for my business, and I'm going to use it in the next 10 years. So if you spend 10 million rand francs, for instance, you can say, I'm going to spread 1 million, this 10 million as a cost over the next 10 years, and it's not going to burden the business. 1 million rand francs divided by 12, you're probably spending around 90 something, 80 something every month, which is quite affordable. So amortization is, investors might ask you, so can you amortize, or what is the amortization rate for this expense that you're going to make? You say, yeah, it's going to be amortized. We're going to do amortization for the next 5 to 10 years for the business, so that it doesn't become a burden to the business. Okay, so that's what amortization means. It's basically smoothing the weight, or alleviating the weight of putting a debt or an expense to the balance sheet all the way or at once. So the purchasing power is the sum total of all liquid assets a business has at its disposal. Okay, it's usually purchasing power is the capacity of people to afford goods and services, but in this context of business finance, what we mean by purchasing power is your bank balance as a business and the assets that you have. Okay, so, and by assets I mean something that is generating money or appreciating in value, not taking money out of your business. Because let's say for a house, it might be depreciating because you're spending maintenance, utilities, and all kinds of maintenance and utility in general, but also maybe property taxes and so forth. But when you account for the valuation and the increase in value over time, you realize that this was an asset because the depreciation, it actually appreciated, the asset appreciated. So, and you end up discovering that, so the appreciation minus the expense that you make, this is actually an asset that can be also joined in the purchasing power class. Then there's cash flow cycle. So cash flow cycle shows how cash moves in and out of the business. So similar to the cash flow statement. So receivables are money you owed by others, while debt is money you owe to others, or what we call there's payable and receivables. So receivables are what other people owes you, and payables are what you owe to others in accounting. So to improve cash flow, it's best to collect payments faster and offer less credit to customers. That's a tip. Okay. Make sure that you collect payment as fast as you can, and then offer less credit to customers. So basically, because you don't want to erode your business with date and more like not receivables. Okay. Next is segregation of duties, and this is a control system that helps prevent theft and fraud in business. I've seen this happening to many founders, where I have a friend of mine who is a founder, and one day he was telling us how he had a co-founder, and that co-founder was literally going to the bank and withdrawing money and using money for their personal use, but without the consent of the co-founders. And when he talked about this, I was like, dude, you should have known segregation of duties, because segregation of duties is segregating the duties or isolating the duties in such a way that one duty is tied into the other. Like you can't withdraw the account without the approval of that, and that the approval of that, and that the approval of that. And because of that, it prevents just theft in general, money to flow out of your business. So when no single person handles all parts of a transaction, authorization, custody, record keeping, reconciliation, it's much harder for mistakes or misconduct to go unnoticed. So this happens all the time for founders who have co-founders, but they don't have proper segregation policies installed in the business. And this is where I think I mentioned that in there's a session I did on business systems that talks about, and this is tied into things like SOPs, because the systems of procedures, that's when you can know and be sure that no one is going to steal from you, or move or mobilize assets, or move money or in the bank account of the business without someone actually approving it. If it's a a solo owned business, or if it's a one person business, or a business that is owned by one person, then it's very easy. You don't need to segregate anything, because everyone that is under you works for you, reports to you, responds to you, and you're responsible for them. You don't need that. But if you have multiple partners, then you need that kind of structure in place in order to prevent theft and fraud, and also avoid quarrels and things that might need arbitration in the business. You want to make sure that everything is in place so that everyone knows what they do, and avoid those conflicts in the workplace. So limited authorization, it goes into also segregation of duty, where it's best to limit each individual's ability to act in areas that are outside the scope of their responsibilities. This is also in businesses, so business systems and operation. So opportunity cost is the value you're giving up when you make a decision. So when you invest time, energy, or resources in something, you're implicitly choosing not to invest it in something else. So paying attention to what you're giving up helps you evaluate past actions and make better future decisions. So in opportunity cost, what we are basically talking about is there is what you're leaving behind, but what it would also cost you if you don't do it. Okay, I'll give you an example. Let's say you say, okay, accountants are very expensive. Okay, that's fine. Okay, the money we're going to pay the accountant, you're going to save it in the bank account. But again, the opportunity cost. How much is it going to cost you if you don't file your taxes properly? How much is it going to cost you if you don't do your books properly? Fines and everything, and problems with the revenue authorities. And then by the time you realize, you're actually paying even more than, that money that you've seemingly saved. So you did not save it. You actually lost it, because you're going to pay even more than what you saved. So to know the opportunity cost in dealings, when you're doing business, it's very important. So time value of money. So $1 today is worth more than $1 in the future. Time value of money helps you decide the best way you use your money by comparing different options. The more you can earn by investing that dollar, the more valuable it is right now. So this is, it's, classic finance. When money, because of the depreciation and everything, it's always advised that, instead of keeping the cash in the bank, you need some cash in the bank always, of course. But there's also a way that you can also do that, but also invest in assets that can depreciate in bank accounts that have interest. Okay, if you're in a country that has a productive or a more advanced stock market, you can do that. S&P 100, ETFs, and others. But when you're saving money, you have to be also aware of the opportunity cost. So you'll be like, I need to keep some cash in the bank account so that when an opportunity presents itself, I'm going to be able to buy, something on the go. But I'm also aware that I need to take some of that money and actually invest it somewhere else, so that it can be making money and actually closing in the gap of a potential depreciation or a potential inflation on the currency, depending on the context in which you're operating in. Then there's compounding. So compounding is when your earnings grow over time by reinvesting them again and again. So let's say you've invested $10, and after a year you have $15, and you actually take those $15, you reinvest them in the business instead of taking them out. Okay, so that five that you've earned, now you're not going to invest $10 anymore, it's 15. Then that 15 becomes 20. You invest 20. Now you no longer have 20, you have compounded. So if you do the addition, it's now around almost 50, because it has compounded. So that they say that compounding is the seventh wonder of the world, because you're taking everything that you've earned, you don't touch it, you reinvest them again. So already you've doubled it. And then by the time you invest again, it has tripled and then quadrupled and then 8x, 16x. So it keeps doubling and doubling. That's the compound. So it's 2, 4, 16, 32, and so forth. It goes, it's exponential. It's not a linear growth. And so by putting your business earnings back into the business, you can grow your original investment many times over. So the key is patience. Compounding rewards those who wait. And this is, if you follow the world of investment quite closely, you might know Warren Buffett. And he is the king of patience, and he retired, but he was the king of patience and compounding interest, because he understood that and how compounding works. And when you understand compounding in business, is actually it's a marvel. So instead of saying, okay, this is the money we've earned in the business, we've covered all the costs, let's go ahead and actually spend it on our own use, or just put it anywhere that you want. How about reinvesting it back in the business so that it actually compounds and grow even faster. So leverage is the practice of using borrowed money to magnify potential gains. And uh, OPM is it's a well-known principle in the finance world. And if you can have that leverage of using other people's money, debts are not taxed. You can have provide a collateral in your shares and everything, depending on what the financial system in your country accepts. But what you have to understand by leverage is that lever that you pull and then you do more with less. Okay. In this context is it's debt, but in other contexts could be media, it could be code, it could be skills, it could be people, because you can leverage 10 people to accomplish to work 100 hours, but you can't work 100 hours on your own. Okay, in a span of 24 hours you have a workload that is equivalent to 100 hours. You can't do that. But because you have people, it's a form of leverage. Skills is a form of leverage. Code, technology, code, algorithms, AI, and software, it's a form of leverage. Media, I always say that, I reach 10,000 people every week. Now, put 10,000 people in an arena and see how those people look like. It's a lot of people that come across my content every week. And there is no way in this world and that I could reach 10,000 people being there physically. It's never. It can't happen. And there are very many big people in this world that don't reach that kind of number every week. And I'm just a regular guy who is making videos on YouTube and posting on LinkedIn and everywhere. But because media is a leverage, I can use it, I can pass through it to reach as many people as I can by just pressing post. That's leverage. Bootstrapping, starting business, art of building and operating a business without outside funding. I'm sure if you're watching this video, you might have started a big or small business with your own money. What you did there was bootstrapping. With your own boots, you strapped the business and you actually went ahead and ran it. Investors might ask you, so have you bootstrapped your business or have you used external money? And now, because you've learned what bootstrap is, then you know exactly what to answer them. That's why we are learning to speak the language of money before it comes, because it's by speaking the language of money that you can actually talk to money and tell it to come. Literally. Yes. Return on investment, is the value created from an investment of time or resources. You've invested 10 million rand and francs. After 2 months or 6 months, you have 14 million rand and francs. The return on investment was almost 50%, 4 million, which is a good return, and then you're good to go. That's what return on investment is. Okay, so sunk cost is investment of time, energy, and resources that can be recovered once they are made. Continuing to invest in a project to recoup lost resources doesn't make sense. So sunk cost it's a trap, because most people they stick in businesses that are actually not profitable, but because they are somehow attached to those businesses, it's a family business, it's my brother's business, it's my business, and they refuse to adjust or change. They keep investing more money into the business, expecting it to resurrect at one point or one day. Then at some point they found themselves in either a lot of debts, or they have just spent money that they will never recover, at least not in that business. So be aware of sunk costs. When you start spending a lot in the business and the business is not producing, giving you back a significant returns to sustain itself or stay sufficient as a business owner, then you can rest assured that those are what we call sunk costs. And sunk costs are just that. They are costs that you're spending, but you're going to sink anyway. So beware of these costs, because they kill businesses, they bankrupt people. I think most businesses reach bankruptcy because they reach a point where they'll be like, they're like, okay, we are going to keep spending more money in this thing. And when you study, if you watch the movie Too Big to Fail, you watch how Lehman Brothers failed. It's because of sunk costs. So they kept spending and spending and spending and spending, except that borrowing, expecting that the bank is going to stay afloat, but it did not happen. So these sunk costs are very real, and it's always very, very. And I always tell people that a business is a business. It's a machine. Don't get attached to it. If it's a hobby, that's fine, because you are aware that you're not going to expect return anytime soon or at all. But if it's a business, my dear, that's serious. These are serious things. There are people who are going to be hurt. Probably you're employing people. You're going to hurt yourself. And I don't advise that you keep spending money when the business, you very well know that the business is not going to generate money or has not generated money for the past 2 years. That's the reality. Internal controls are set of specific standard operating procedures a business uses to collect accurate data, keep the business running smoothly, and spot trouble. So these internal controls are, I would call them settings and schools that are in the business, in different joints or choke points of a business. It could be in accounting, in finance, in HR, in customer experience, where you're like, okay, yeah, before you spend this money, that there's something that has to be fulfilled. That's an internal control. Maybe someone has to approve it. Segregation of duties that we were talking about. These are internal controls that you put. Maybe before this document goes out, there's someone who has to check it before it goes out. That's an internal control, and this is done. These are installed in your business when you have systems of procedures. Most African businesses don't have systems of procedures, and because they don't have systems and they don't have documented procedures, then they don't have internal controls, and consequently, that's why most businesses are just a mess. And working for a local company, if you worked for a local company, you know how hard it is to work for them, because they don't have all of these things. And when something goes wrong, it's always a blame game. People are shifting blame, blaming each other, and then it's very counterproductive and not a very good setting for your career or your professional journey in general. So in a nutshell, this is what I would say are the basics of terminologies that you need to know as a business owner. I'll probably share this a PDF on LinkedIn so that people can have it and you can refer to it as you go. But once you know this, you can be very, very conversant when you are doing business with different people. But there are also other terminologies, and I always advise people go and read, read finance books and familiarize yourself with these terminologies. So until next time, I thank you for watching up until the end. And until next time, I'll see you guys in the next one. And make sure that you share this video, like and subscribe so that we reach as many people as we can. And thank you very much. Take care. Bye.